Welcome to Investors Guide. You're watching ET Now. Thank you so much for joining us. On this show, we sift through the entire market and put together a portfolio that suits your needs best. Now remember, every time you save a rupee, it's like earning a rupee. We're going to help you invest that money so it grows and works just as hard as you do every day in the office. On the show this week, we're focusing specially on women investors and young people. You can send in questions that you have to the email ID that's on your screen right now. Over the next half hour, we'll help a young woman create a corpus for her daughter's future. In our product review, we'll find out if it makes sense at all to stay invested in the Morgan Stanley Growth Fund. We'll tell you how much you can earn if you skip buying that smartphone today. All right, let me bring in Kumar, the CEO of Value Research. Thank you so much for joining us on Investors Guide. Let's get straight to our first question. We have a question this week from a woman investor. Now, Sai Lavanya writes in from Navi Mumbai, Dhirendra. She tells us her husband earns a monthly income of 50,000 rupees. They've been married for 2 years and they have a little daughter who's a year and a half old. Now, they pay 9,000 rupees as rent and 26,000 rupees for other monthly expenses. Now, they don't have an emergency fund and they have no health cover or term cover. But Lavanya will receive 10 lakh rupees from her father in a couple of months and she wants to allocate this money. Now, she's already told us 1.5 lakh rupees she wants to set aside for a family function over the next 3 months. She wants 2 lakh rupees to be put aside for her daughter's preschool, which will be 2 years from now. And the remaining about 6.5 lakh rupees for her daughter's future, her higher education, that will likely to come up in the next 18 years. Now, she tells us currently her husband saves about 4,000 rupees every month and he's putting this money into a gold fund, into a pure equity fund, into an RD and a PF. Now, this is spread 1,000 rupees each. He can, starting now, put aside 5,000 rupees more every month and she wants you to help her allocate that money as well. Let's start first with the money she's getting from her father. Should she first and foremost think about that emergency fund and the health insurance before thinking of a family function?
I think absolutely. That's very important because all her investment plans will go haywire if she's faced with a medical situation or where the finest of investment plan will actually fail. So it is very important to have that cover before and have that emergency fund handy. Otherwise, that also has the potential to disrupt any investment plan. So these two things once in place, then she can get started. And I think plenty of time in hand, good lump sum amount available to begin with. She should approach investments very conservatively. So I would say look at our stable growth portfolio. The 6.5 lakh rupee which you are left with after your immediate expenses, which is the investable surplus of these 10 lakh rupees which is being made available. That should be spread over next 12 to 18 months in our stable growth portfolio. And once you are done with this, once you have through with this, then even the incremental money, the 5,000 rupee going into investment can also well be channelized there. All
right. So, Lavanya, first and foremost, unfortunately, we don't want you to set aside that money for a family function. Now, given your expenses and your rent, you need to put aside at least 1 lakh rupees in an emergency fund in a separate bank account purely for emergencies in case somebody loses their job or you need the money right away. Health insurance and a term cover for your husband who's your only earning member. You're going to have to set aside between 40,000 rupees almost to cover both of the premiums that you'll have to pay for both of those. And Dhirendra, they're giving you our stable growth portfolio for investments going further. But Dhirendra, for the money she wants to set aside for her daughter's preschool, which will be in 2 years' time, obviously you don't want that money going into even partial equity. Where would you like her to set that money into?
Because, given that this money is coming in the form of a gift, so she can consider a 2-year deposit.
Right, a 2-year deposit for your daughter's preschool money. But in the meantime, Dhirendra, there's money going into a PPF and a recurring deposit at 1,000 rupees each every month. Do you want them to continue making that investment as well?
No, as I suggested that, all the money, even the incremental money should find its way into the stable growth portfolio. One thing which comes to my mind that if her husband is in the tax bracket and he needs to make the tax saving investment, maybe a part of this, all this investment should get into a tax saving fund, which will get him the tax break.
All right. So our tax saving funds are on your screen right now. This is the recommendations for tax saving funds for this year. And remember, if you use a stable growth portfolio instead of using a recurring deposit, after a year, all of those returns are also tax free. You can write back to us if you have any more questions about your money. Let's take another question. Kalyan has written in there that he wants to know where he can invest 10,000 rupees every month or 1 lakh rupees every year to get an interest of 10 to 15%, and he wants a guaranteed interest and no risk on his capital. 15% seems like a really long shot, Dhirendra. Does a recurring deposit make most sense for him?
Yes, recurring deposit makes sense, but one should be conscious of this. When you are seeking guaranteed return, then you will get low return. That apart, it will all be taxable. One is that equities do give you superior return over a longer period. This is your long-term investment, but you're extremely uncomfortable. So I would say that you have a very clear choice. You will get post-tax return of 7-8%, which will be guaranteed, or else you will have to take chances, and the potential return might be higher, but you will have to, reconcile with the ups and downs of the market. And if this is a long-term investment, I'm sure that you are unlikely to be disappointed.
Well, Dhirendra, for other investors like Kalyan, now Kalyan has not told us what his investment horizon is. So what he needs the money for, how long it's going to be invested, he hasn't told us. But for the viewers who are watching right now, how do they pick between putting their money into a recurring deposit or into a debt fund, which is similar, but of course the risks are very different? How do we choose which one suits us better?
Both have their, their own advantages and disadvantages. When you do a recurring deposit, you get guaranteed return. It has wide accessibility. Any neighborhood bank will provide you a recurring deposit, though accessing mutual fund may not be that easy. That apart, many mutual fund advisors will not be very, you will not get great service in terms of choosing a fund and doing a SIP in a debt fund like a recurring deposit. And that apart, not getting a guaranteed return.
All right, I hope you wrote that down. Now we're going to take a very quick break. When we come back, Dhirendra is going to stay with us. And in our fund review this week, we talk about the Morgan Stanley Growth Fund. Don't go anywhere. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. It's time for our product review. And this week, we're looking at the Morgan Stanley Growth Fund. Avan is here to give us an introduction. Avan.
Thanks for that, Faye. Now, as we already know, the announcement was made in December last year. HDFC Mutual Fund AMC is acquiring Morgan Stanley's mutual fund assets in India. And our fund in focus this week is one of the assets that will soon be an HDFC fund. The Morgan Stanley Growth Fund was launched as a close-ended fund in February 1994, but turned into an open-ended fund in Jan 2009 after 15 years in operation. During this period, the fund gave investors an annualized return of 10%, well below its peers, the Franklin India Blue Chip and the Franklin India Prima Fund, which returned 23.81% and 16.91% respectively. Even after that period, the fund has failed to impress, failing to recover from the crash of 2008 when it fell 50%. Over the years, the fund has floundered in the middle of its category, never rising to the top of the leaderboard. To sum it up, if you invested 1,000 rupees in this fund when it launched, you would have 6,897 rupees today. Keeping in mind the fund's underachievement, is it time for you to pull your money out? Or will the fund managers of HDFC be able to save this fund? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, thank you so much for that update. Well, Dhirendra, the Morgan Stanley Growth Fund has not been a performer. And to add to that, Morgan Stanley has now sold all of those Indian assets to HDFC. So there will be a transition that will also take place. Does it make sense at all for us to hang on to this fund and to stay invested and wait for that transition?
Yes, on a risk-adjusted scale, it has improved a little bit, but that doesn't make much of a difference because this is a very mainstream category. And quite a few, significant change. One is that, when we look at the 20-year performance of this fund, it is extremely disappointing. Also compare it with, another fund which was launched exactly at the same time. Then this fund was Zurich India Capital Builder, launched in the same month, same year. And when we look at the NAV, it is twice as much. 65 rupee and 125 rupee makes hell of a difference. That apart, Morgan Stanley Growth Fund had an unusual advantage. It started as a closed-end fund and remained one for first 15 years. Only 5 years back, it got converted into an open-end fund at the expiry of its closed-end term. So it was at absolute liberty to take a call build a portfolio the way it wanted to. It was not faced with, daily redemptions and inflows into the fund, which normally is, many a times, it is a constraint for a fund manager to operate.
Well, if you're investors of inertia, like Dhirendra says, and you put your money in the Morgan Stanley Growth Fund and you haven't removed your money for this long, it's time to move your money now. Dhirendra, could you give us alternative investments if you're going to pull our money out of this fund right now?
Go for our selection of multi-caps, which is Quantum Long-Term Equity Fund, or ICICI Prudential Dynamic, or Templeton India Equity Income Fund.
3 funds on your screen right now as alternatives to this fund, the Morgan Stanley Growth Fund. Remember, Dhirendra said it's time to pull your money out. Even if it's moving to the HDFC basket, don't wait for that move. Pull your money out right now. Dhirendra, finally, give us your rating of this fund. You gave it 2 stars last time. Where would you place it this time?
I'll place it there itself. It has been a below average performer, not a disaster, but not a fund worth, remaining invested.
All right, not a fund worth staying invested in. That's the Morgan Stanley Growth Fund on Investor's Guide. Let's move on to our hold or sell segment. Well, H.S. Karkera has written in, Dhirendra, he's a 65-year-old retired banking officer. He puts aside 60,000 rupees in 12 mutual funds every month. Now, he tells us this is money that comes out of his fixed deposits and interest from his other investments. He wants to bring down that investment to 30,000 rupees a month for the next 10 years with the hope of creating a corpus of 1 crore rupees. He sent us a list of the funds on his investment chart, and I want to take them together because 12 funds is a long list. Right on top, Franklin India Blue Chip and ICICI Prudential Focus Blue Chip. Would you like him to continue investing in both of these funds?
Both these funds are good large cap equity fund, and so depending on his time frame, and these 2 funds, if I have to choose 2 large cap fund, it will be these. So maybe it's worth being there.
And he's also investing in the ICICI Prudential Dynamic and the Franklin India Prima Plus Fund. Dhirendra, continue these investments as well?
Yeah, these 2 funds again, they are. He has chosen his funds carefully and relatively superior funds with superior performance. So these are again, 2 large and mid cap funds which are doing very well and worth holding.
I'm going to take the next 3 funds together. He has L&T Equity, Reliance Equity Opportunities and the IDFC Premier Equity Plan. He has a slightly larger amount going into IDFC Premier Equity. Dhirendra, continue with this investment as well?
Yes, I would say that Prima Plus could well be a mainstream fund, and likewise, the IDFC Premier Equity is a very impressive fund, has been particularly impressive through the lean times. So, in fact, it has done well than most others.
He also has the Canara Robeco Tax Saver Fund, Dhirendra. This has popped up several times when we've talked about tax savers. It's a fairly impressive fund. Should he continue that investment? Assuming, of course, it's an SIP, he won't be allowed to pull that money out for the next 3 years.
Yes, this has been our recommendation for a while, and this fund continues to do well. And so if this is his ATC allocation, 60,000 rupees a year by way of 5,000 rupees per month, he can carry on.
He also has a mid and small cap fund. This is the DSP BlackRock Small Cap Fund, 5,000 rupees every month. Continue this investment as well, along with the SBI Magnum Emerging Business, and this has been quite a performer. Both of these funds in his portfolio, would you like him to continue both of them?
If he has the patience to stick with the small and mid cap through the lean times in the market, then it's fine. Otherwise, if he wants a low maintenance portfolio, then he should eliminate the large caps and the mid and small cap funds and remain focused in 4 or 5 funds which he has, something like ICICI Prudential Dynamic or Prima Plus, which will become a low maintenance portfolio. He won't have to bother much.
He also has the IDFC Sterling Equity, Dhirendra, and he has 1 gold fund, the Kotak Gold Fund. Now, obviously, I know you're going to say no to the Kotak Gold Fund, but the Sterling Equity Fund, continue that one?
Yes, continue this one as well, because this is also a very impressive fund. So one is that he has chosen good funds. He has chosen funds with credentials, and these funds continue to do well. Continue to manage the way he has done so far, then it's fine. Otherwise, he should scale it down to make it low maintenance portfolio.
So, Dhirendra, just for his benefit, if he were to scale it down, and ideally, like you recommend, 4 or 5 funds are the easiest to manage, which of these funds of this entire list can you pick 4 that he should ideally hold on to?
I would say that, if I have to choose 4 funds or, even 5 funds, taking into account the tax saving fund, I would go for ICICI Prudential Dynamic, Prima Plus, the L&T Equity Fund and Reliance Equity Opportunity.
All right, so that's a job made much easier for you. Dhirendra, picking only 4 funds out of your entire list. Of course, add that tax saver because you can't pull the money out right now. And you have an easy to manage portfolio that you can continue for the next 10 years. We have another question from Manoj Patel, who's written in, Dhirendra. His son is 1 year old. He would like to create a corpus of 30 to 35 lakh rupees for him after 15 years. He wants to know where he should invest his money right now to achieve that goal. So obviously, it's a very, very long-term goal, Dhirendra. Would you like him to pick one of our portfolios?
Yes, I would like him to, go for our growth or aggressive growth portfolio. But the important thing will be that, after 10-12 years, he should start moving the money into fixed income gradually, depending on the cash flow requirement, as and when he gets closer to his goal for spending or consumption, then he should be moving a part of his assets or as much needed into more stable asset class, which is fixed income.
All right, I'm going to quickly squeeze in one more question before we go into break. Jay Shrikant has written in. Now, he tells us he's pulled his money out of the HDFC Top 200 fund already. He has a lump sum amount in his bank account. He wants to know if he should put that money right now in ICICI Prudential Dynamic or the ICICI Prudential Balanced Advantage Fund, and should he make a lump sum investment? He hasn't told us what this money is for, but between the two funds, Dhirendra, which one would you like him to pick?
So I look at ICICI Prudential Dynamic more as a equity fund, and the other one as a balanced fund, which is a more conservative option. So if he wants a mainstream equity fund, ICICI Prudential Dynamic. If he has turned conservative, or he's very upset with a substantial decline in value over a brief period of time, then go for the balanced advantage fund.
All right, so it depends really on what sort of an investor you are at this point. And if you have any more questions for Dhirendra, write to us. Our email ID is at the bottom of your screen. Dhirendra, thank you so much for spending time with us this week. We're going to take a very quick break, but we'll come back on the other side. We'll answer more of the questions you sent in during the week, and we'll also tell you how much you can save if you skip buying that new smartphone. Welcome back. You're watching Investors Guide on ET Now. Thank you for joining us. We're bringing back our Power of Compounding segment, and there's a reason for this. Every time I speak to young people, they always complain about the fact that they just don't have enough money to save. I just don't save enough money at the end of the month, so I can't invest any money, and that's normally the excuse that I hear. And we're going to try and solve that problem. We do know that if you're flashing a new iPhone 5 or something of the same level, you've spent upwards of 40 to 50,000 rupees on an easily depreciating asset. Now, here are some numbers on what it will mean if you skipped that phone and invested the money through your working life over the next 30 years. Take a look.
Technology moves so quickly that every time you shop for a brand new toy, there is a new one, a better, faster, slimmer toy. The technology industry is a sharp competitive industry, all battling for a hearty slice of your wallet. The latest lineup of toys are priced at an upward of 40,000 rupees. Now we know you like the best. But give this thought a moment. Let's assume you do not buy that smartphone and invest the money instead. Over 30 years, if your investment gave you 12% every year, you would have 11,98,400 rupees. That's nearly 30 times your starting value. Even if your investment gave you a conservative 10%, you would still have 6,97,976 rupees over 30 years. And that is 17 times the value you started off with.
So if those numbers were shocking, then you'll stop complaining about not having enough money to invest. Write to us if you want any more advice on how you can save more money in your daily life. This Power of Compounding segment will be a regular on the show. Now let me also bring in Gaurav Mashruwala, who has some answers to the questions you sent in during the week. Well, D.R. Patel has written in. Now he tells us he has an annual income of 3 lakh rupees and he wants to start putting money aside for his child, which is about 10,000 rupees every month, and for his own retirement, so 15,000 rupees every month, to cover that over the next 10 to 15 years. Now, he already has some money, Gaurav, going into the PPF, into a post office savings scheme. He wants to know if he should invest in mutual funds, how many funds should he invest in, and should he use 2 separate funds for his 2 separate goals. Gaurav.
So, Mr. Patel, here are things. Continue with your contribution to post office life insurance as well as PPF, because PPF is one which is A, secured, gives you a good tax-free return. Even when you put in money, you get tax benefits. For your other goals, since they're 20-25 years away, what you may want to do is, instead of treating two goals separately, you may want to create a single kitty. Now that kitty can be created with the help of 3 equity funds. You can pick up one as a core, a larger amount into an index fund, which could be a Sensex or a Nifty fund. And then you can have 2 more SIPs, one going in large cap fund, actively managed fund, and one a mid and small cap fund. The proportion should be the maximum amount in index fund, slightly lesser, say about 50% in index fund, another 30% in large cap fund, and residual in mid and small cap fund. Mid and small cap funds are highly volatile, they are susceptible to risk, but over a longer period of time, they are capable enough of generating higher returns, and hence I am encouraging you to take that risk since time horizon is more than 2 decades.
Our next question comes in from Brijesh, who's 25 years old, and he wants to put aside 25,000 rupees every year. Brijesh, we're so proud of you. He wants to put this money aside for the long term, and he wants the best possible returns, like most young people. Gaurav, where would you like him to invest that money?
So Brijesh, you're looking at investing a regular amount, and you're looking at growth, and you're looking at retirement at a younger age, which is a brilliant thing. Now, ideally, the asset class that you should opt for is equity. So do an SIP into an equity-based mutual fund. There will be a lot of scheme names and growth portfolio which would be displayed, and you may want to pick and choose from that. Long-term basis, if you have skills and time, go for an actively managed fund and keep tracking once every quarter. Don't do it less than that, and don't be lethargic and just kind of let it be swayed away. If you don't have skills, or if you don't have time, or either of them, then you may want to look at an index fund. You may either want to look at a Nifty fund or a Sensex fund, where you don't have to spend a lot of time and energy to keep looking at how that fund is performing. It will kind of replicate the Sensex or Nifty. So long-term basis, retirement planning, enough time, equity as an asset class, do an SIP into an equity fund.
Alright, so that's a wrap on Investors Guide. Now remember, on this show, we have a special focus on women investors and of course, young people who are just starting off. So if you have any questions, and it doesn't matter what your question is, feel free to write to us. Our email ID is at the bottom of your screen. You can reach me personally on Twitter if you'd like to get in touch and give us some feedback. Thanks so much for watching.